Disclaimer.
Something happened in Australia last night that should have every silver owner in America checking their portfolios right now. The Perth Mint, one of the oldest and most trusted precious metals institutions on the planet, just stopped taking orders for their flagship silver kangaroo coins. Not reduced capacity, not delayed shipping. A complete halt on new orders, effective February 23rd. And if you think that's just Australia's problem, I need you to pay very close attention to what I'm about to share with you. Because here's what the mainstream financial press isn't connecting for you. Right now, silver is trading at $84.57 per ounce, and there's a mathematical scenario unfolding that points to $91 by this Thursday. That's not some wild prediction pulled from thin air. That's what happens when you follow the actual delivery numbers coming out of the Comex warehouse system and realize that we're watching a supply crisis unfold in real time. Let me put this in perspective for you. Think about what it means when a 125-year-old mint suddenly can't fill orders. The Perth Mint has operated through 2 world wars, the Great Depression, multiple financial panics, and every precious metals cycle you can imagine. They've never done this before. Not once in their entire history have they halted orders on their primary silver product. So what changed? The answer lies in what's happening right here in our own backyard, in the Comex vaults that settle most of the world's silver contracts. February deliveries just hit 22.5 million ounces. Now that number might not mean much until I tell you this represents 4.5 times the delivery volume we saw in previous months. 4.5 times. The people who actually hold silver contracts aren't rolling them over into the next month like they usually do. They're demanding physical metal, they want their silver, and they want it now. Here's where the math gets uncomfortable. The Comex registered inventory, that's the silver actually available for delivery, sits at roughly 85 million ounces. Sounds like plenty until you realize there are contracts outstanding representing 425 million ounces. Pop quiz. What happens when you have $5 worth of claims for every $1 actually sitting in the vault? You get exactly the kind of panic we're starting to see spread from Perth to American dealers. And our government just made the situation significantly more complicated. You might have missed this because it didn't get much coverage, but silver recently received official designation as a critical mineral for national security purposes. What does that mean practically? It means the strategic stockpile is now actively ramping up silver purchases. The same government that stockpiles oil for emergencies, that maintains reserves of rare earth elements, is now competing with you and me for available silver supply. Think about that timing for a moment. Right when industrial demand is surging, right when solar panel manufacturers and electric vehicle producers are scrambling for every ounce they can secure, our own government enters the market as a major buyer. This isn't speculation about what might happen someday. This is happening right now. And it explains why Samsung just paid $7 million in advance prepayments to secure mine production before that silver even comes out of the ground. When one of the world's largest technology companies starts paying miners up front for silver, they won't receive for months. That tells you everything about where smart money thinks this market is heading. Samsung's engineers aren't precious metal speculators. They're supply chain managers desperately trying to ensure they have the raw materials to keep production lines running. And they're willing to lock in prices months ahead because they believe waiting could cost them far more. Now here's what connects all these pieces into a single urgent picture. February 27th is first notice day for Comex silver contracts. That's the deadline when contract holders must declare whether they want cash settlement or physical delivery. And this month, the numbers suggest we're heading into that deadline with the most stressed delivery situation we've seen in years. The ratio everyone should be watching is paper to physical. Right now, roughly 5 ounces of paper silver contracts exist for every 1 ounce of actual metal available for delivery. During normal markets, this works fine, because most traders never actually want the metal. They're speculating on price movements, hedging industrial exposure, or managing currency risks. They close their positions before delivery ever becomes relevant. But what happens when the psychology shifts? What happens when enough traders look at Perth Mint halting orders, look at Samsung prepaying for mine output, look at the US government stockpiling silver as a strategic resource, and decide maybe they actually do want physical metal this time? The system isn't built to handle everyone demanding delivery simultaneously. The whole structure depends on most people accepting paper settlement and rolling contracts forward. This is exactly why the Perth Mint situation matters so much for American silver owners. Australia just showed us what happens when physical demand overwhelms available supply. Orders stop. Premiums explode. The price you see quoted on financial screens disconnects from the price you'd actually pay to hold real metal in your hands. And that breakdown is spreading. Have you checked premiums at American dealers lately? The gap between spot price and what you'd actually pay for physical silver has been widening for weeks. Some dealers are already reporting 3 to 4 week delays on popular products. Others have suspended orders entirely on certain items. This isn't the silver market you might remember from 5 or 10 years ago. The supply chain is genuinely strained in ways that haven't fully registered in spot prices yet. Here's what should grab your attention about the next 72 hours specifically. When Perth Mint's order halt hits international markets Monday morning Asian time, we're likely to see an immediate repricing in physical premiums across the region. That repricing creates arbitrage pressure that eventually pulls spot prices higher. And all of this happens against the backdrop of Thursday's first notice day deadline, when Comex participants must commit to paper or physical settlement. The scenario unfolding is one where multiple pressure points converge simultaneously. Industrial buyers competing with government stockpiling, paper contract holders waking up to delivery risks, international mints reaching capacity limits, and American dealers caught between surging retail demand and constrained wholesale supply. Each of these factors alone would support higher prices. Together, they create conditions for the kind of gap move that catches casual observers completely off guard. If you own silver in any form, whether that's physical coins in a safe, shares in a mining company, or positions in a silver ETF, the decisions you make before Thursday's deadline could significantly impact your returns. Because here's the uncomfortable truth about paper silver products. When physical premiums explode and delivery stress hits the system, paper vehicles don't capture that upside. They track the official spot price while physical holders enjoy premiums that can add 20, 30, or even 50% to their actual realized value. The choice facing silver owners right now isn't complicated, but it is urgent. Do you hold paper exposure that tracks a potentially artificial price? Or do you secure physical metal before American dealers implement the same kind of rationing we just witnessed in Australia? That's not a rhetorical question. It's the calculation every serious silver investor needs to make before first notice day arrives. And what I'm about to show you next will make that decision even clearer. Because when you look at the actual withdrawal numbers from Comex vaults, when you examine what happened the last time we saw this kind of delivery stress, the pattern reveals something the mainstream analysis completely misses about where silver prices are actually heading. Let me show you the numbers that Wall Street analysts aren't putting together for you. In January 2026 alone, 33 million ounces of silver walked out of Comex registered vaults. That's not a typo. 33 million ounces in a single month, representing 26% of the entire registered stockpile. When more than a quarter of available delivery inventory disappears in 30 days, something fundamental has shifted in how major players view this market. But here's where the pattern gets really interesting. We've seen this movie before, and knowing how it ended last time should inform every decision you make this week. Cast your mind back to March 2020, when COVID panic sent financial markets into freefall. Silver spot price collapsed to $12 an ounce on paper exchanges. Traders were dumping contracts in a liquidity crisis, and if you only watched the ticker, you'd think silver had become almost worthless. Except something strange was happening at coin shops and bullion dealers across America. While screens showed $12, actual physical silver was selling for $25 an ounce when you could find it at all. That's more than double the paper price. The disconnect between what contracts traded for and what real metal cost became impossible to ignore. And what happened next? Silver staged a 148% rally over the following months, as paper prices eventually caught up to physical reality. Now, here's why the current setup is actually more explosive than 2020. Back then, the silver market was roughly in balance between industrial consumption and mining production. Today, according to the Silver Institute's latest survey, we're running an annual deficit of 200 million ounces. Every single year, the world consumes 200 million more ounces than miners pull from the ground. That gap gets filled by drawing down existing inventories, recycling scrap, and liquidating investment holdings. But those sources aren't infinite. The deficit has persisted for 3 consecutive years now, and it's accelerating rather than shrinking. Solar panel installations are breaking records globally, electric vehicle production keeps ramping despite economic headwinds, and every smartphone, every computer, every piece of medical equipment contains silver components that manufacturers can't substitute away from. The industrial demand side isn't speculation about future technology, it's current consumption that's already baked into production schedules worldwide. So when Perth Mint halts orders after 125 years of continuous operation, we need to understand this isn't an isolated incident. It's a symptom of systemic supply stress that's been building for years and is now reaching a breaking point. And remarkably, we've already seen this exact scenario play out at another major sovereign mint. Remember what happened at the Royal Canadian Mint in 2020? They suspended retail sales completely during the COVID disruption. The official explanation cited production constraints and shipping logistics, but the underlying reality was simpler. Physical demand had overwhelmed their capacity to source enough raw silver to meet orders. Canada's national mint, backed by government resources and over a century of operational expertise, simply couldn't get enough metal. Perth Mint's current halt carries even more significance because it's happening during what should be normal market conditions. No pandemic, no financial crisis, just steady, relentless demand meeting constrained supply. The premium numbers tell the story. Australian buyers are now paying 143 Australian dollars per ounce for physical silver, which translates to roughly 95 US dollars. That's a 20% premium over spot price, and it represents what real buyers are actually willing to pay when paper quotes become meaningless. This physical decoupling from paper prices isn't confined to Australia. It's a global phenomenon driven by the explosive growth in silver-intensive technologies. Electric vehicles require roughly 1 ounce of silver per vehicle for electrical contacts, battery connections, and control systems. But the real silver story is solar energy. A single solar panel contains approximately 20 grams of silver for its conductive paste and electrical connections. Multiply that by the millions of panels being installed annually, and you begin to understand why industrial buyers are panicking about supply. The demand picture gets even more complicated when you factor in what governments are doing. China, the world's largest silver refiner, recently implemented export curbs on refined silver products. They're keeping more metal inside their borders for domestic manufacturing, rather than shipping it to Western markets. This single policy decision removes millions of ounces from global availability precisely when Western demand is surging. And then there's our own government's activity, which has flown almost completely under the radar of mainstream financial coverage. Project Vault, the initiative to rebuild American strategic mineral reserves, has been quietly accumulating silver alongside other critical materials. The exact purchase volumes remain classified, but industry sources tracking warehouse movements report unusual withdrawal patterns consistent with large-scale government accumulation. Our tax dollars are being used to buy silver at these prices because national security planners understand something that most retail investors don't. Silver isn't optional for a modern military or technology-driven economy. What do the big banks make of all this? JP Morgan, which has historically been one of the largest players in silver markets, recently published their 2026 price forecast. Their base case calls for an average price of $81 per ounce. That might sound conservative given where we are today, but read the fine print. Their analysts specifically note potential for price spikes above $100 during periods of delivery stress. And they wrote that assessment before Perth Mint halted orders, before the February delivery numbers came in 4.5 times above normal. Here's what institutional analysts understand that casual observers often miss. Silver price doesn't move in smooth, predictable increments. It tends to trade sideways for extended periods, building pressure as supply constraints accumulate, then releases that pressure in explosive moves that happen over days or weeks rather than months. The structure of the market, with its heavy paper trading and relatively small physical float, amplifies both directions. When silver moves, it really moves. The evidence trail leads to an uncomfortable conclusion. Every major signal, from sovereign mint capacity limits to record Comex withdrawals to government stockpiling to industrial prepayment deals, points in the same direction. Physical silver is becoming genuinely scarce at current prices, and the paper market hasn't fully adjusted to that reality yet. The 20% premiums in Australia aren't an anomaly. They're a preview of what happens when paper prices can no longer be defended against physical market reality. Think about what it means when JP Morgan's own analysts acknowledge $100 plus spike potential. These aren't permabulls or social media promoters. These are the same institutional voices that typically downplay precious metals in favor of traditional financial assets. When they start building triple-digit scenarios into their forecasting models, it suggests the internal data they're seeing tells a story they can't ignore. The proof is in the withdrawals, the premiums, the mint halts, the industrial prepayments, and the government accumulation. Each piece of evidence independently suggests tight supply conditions. Taken together, they describe a market that has fundamentally shifted from paper-dominant to physical-constrained. And that shift has implications for price that most analysis completely underestimates. Which brings us to the calculation that every silver owner needs to understand before Thursday's deadline. Because when you run the actual numbers on delivery capacity, contract exposure, and deficit accumulation, a specific price target emerges that explains why the next 72 hours matter more than the next 72 weeks for your positioning in this market. Let's do the math together because the numbers don't require interpretation. They simply are what they are. February Comex deliveries came in at 4.5 times the normal monthly volume. If that delivery rate continues through first notice day on February 27th, we're looking at withdrawal demands that physically cannot be met from current registered inventory. The system would need to pause, delay, or force cash settlement on contracts that holders intended to convert to metal. Think about what that actually means in practice. You bought a contract specifically because you wanted silver delivered to your account. You paid for that right. You followed all the rules. And then the exchange tells you, sorry, we don't actually have enough metal. Here's cash instead at whatever price we determine is fair. That's not a theoretical scenario. That's what delivery failure looks like, and the current trajectory points directly toward that outcome. What happens to price when a major exchange effectively admits it can't deliver the product it's been selling? We don't have to guess. We can project based on how markets respond to delivery failures, price gaps higher, often violently, as the paper market scrambles to reflect physical reality. And the specific target that emerges from this calculation is $91 by Thursday. Here's how that number derives step by step, so you can verify the logic yourself. Silver closed Friday at 84.57. Perth Mint's order halt becomes global news when Asian markets open Monday morning. Australian premiums are already running 20% above spot, which translates to real-world pricing around $95 for physical metal. When Asian traders see a major sovereign mint unable to fill orders, they'll reprice their own physical exposure accordingly. That repricing pressure flows through to Comex futures within hours. Now layer in the domestic catalyst. American traders arrive at their desks Monday morning to headlines about Perth Mint and weekend analysis connecting it to Comex delivery stress. The smart money doesn't wait for confirmation. It positions ahead of anticipated moves. By Monday's close, we could already see silver testing $87 or $88 as the market begins pricing Thursday's deadline. Tuesday brings more attention, more analysis, more buying from traders who recognize the setup. Wednesday becomes the last chance for positioning before first notice day locks and delivery commitments. The gap between current spot and the $91 target represents approximately a 7% move. In normal markets, that would seem aggressive for a few days of trading. But these aren't normal conditions. We're watching multiple catalysts converge simultaneously, and markets tend to price that convergence all at once rather than gradually. The Perth news alone might move silver 2 or 3%. Layer on the Comex delivery stress approaching first notice day, and you get the conditions for a gap that erases weeks of normal price discovery in a single session. But here's what most analysis misses about how these moves actually unfold. Silver doesn't climb steadily like a stock responding to earnings beats. It compresses and releases, building potential energy during quiet periods and then discharging that energy in explosive moves that catch casual observers off guard. The compression phase has been building for months. The release phase could begin Monday morning. And $91 isn't the end of this story. It's potentially just the beginning of a move that extends through March and beyond. When you combine the 200 million ounce annual deficit with 20% physical premiums already being paid in international markets, the projection range extends to $95 to $110 by the end of March. That's not a ceiling. That's a base case scenario, assuming delivery stress gets resolved relatively smoothly. Let me put those numbers in terms that matter for your actual portfolio. If you hold 100 ounces of physical silver right now, you're looking at a potential value increase from roughly $8,450 to somewhere between $9,500 and $11,000 within the next 5 to 6 weeks. That's not counting premium expansion, which could add another 15 to 25% on top of spot price appreciation. We're talking about potential gains of $3,000 to $4,000 on a modest 100-ounce position. What if delivery stress doesn't resolve smoothly? What if first notice day reveals that Comex simply doesn't have enough registered silver to meet standing delivery requests? In that scenario, we could see the kind of disconnect between paper and physical markets that makes 2020 look tame by comparison. Premiums could spike to 30, 40, even 50% as physical holders realize they own something the paper market can't actually deliver. Have you ever tried to buy something during a genuine shortage? Not a temporary supply chain hiccup, but an actual shortage where demand overwhelms supply across the entire market? Prices don't rise politely. They jump to whatever level clears the market, which often means multiples of the pre-shortage price. Silver's industrial essentiality makes it especially vulnerable to this dynamic. Manufacturers can't just substitute something else for silver in solar cells and electronic contacts. They need the metal, and they'll pay whatever it takes to keep production lines running. Let me walk you through what this means practically for different types of silver owners, because your positioning determines how much of this move you actually capture. If you hold physical metal, coins, bars, rounds, anything you can actually touch, you're positioned for exactly this kind of market. When premiums explode, your realized value isn't the spot price on a screen. It's whatever a buyer will pay to hold real metal in a delivery-stressed environment. Your position captures both the spot move and the premium expansion. Picture this scenario. Spot, silver hits $91 Thursday. Physical premiums expand to 25% as dealers scramble to restock depleted inventory. Your 100 ounces of physical silver aren't worth $9,100. They're worth $11,300 because that's what buyers will actually pay for metal in hand. The 25% premium represents real money in your pocket that paper holders never see. If you hold mining stocks, you'll participate in the spot price movement, but not the premium expansion. Miners sell their production based on spot prices negotiated through wholesale contracts, not retail premiums. You'll still benefit significantly from silver moving toward $91 and potentially beyond, but you won't capture that extra 20 or 30% that physical holders enjoy when the delivery system strains. Mining stocks also carry company-specific risks, management decisions, cost inflation, and operational challenges that can disconnect your returns from silver's underlying move. And if you hold paper silver products, ETFs, futures contracts, or certificates, here's where you need to think carefully about what you actually own. These instruments track the official spot price by design. When physical premiums explode, your ETF doesn't suddenly reflect that premium. You own a claim on silver that settles at spot, which could be dramatically lower than what actual physical metal trades for in the real market. Consider the mechanics of a silver ETF during delivery stress. The fund holds some physical metal and some paper claims. When redemptions increase or the fund needs to rebalance, it must acquire metal at prevailing market prices, including any premiums. But your shares still track spot price, not the fund's acquisition costs. You get the movement in the official price, while the fund absorbs premium costs that erode net asset value over time. During extreme stress, some ETFs have even suspended redemptions entirely, trapping holders in positions they can't exit at any price. This is the choice facing silver owners right now, and the window to make that choice is closing fast. By Thursday's first notice day, the delivery picture becomes fixed for February contracts. Whatever stress exists in the system gets revealed publicly through official exchange data. And historically, markets don't wait politely for that revelation. They front-run it, pricing in anticipated stress before the official numbers confirm it. The traders who profit most are positioned before everyone else recognizes what's happening. The warning I need to share is specific and time-bound. Silver owners face a potential $10 gap between now and Thursday. That's the difference between current spot and the $91 target that delivery math supports. If you're holding paper exposure and that gap materializes, you'll capture it. But you'll miss the premium expansion that could add another 25 to 30% for physical holders when dealer rationing begins post-FND. American dealers are already showing signs of strain that most retail buyers haven't noticed yet. Lead times have extended from same-week shipping to 3- and 4-week delays on popular products. Inventory dashboards that used to show abundant availability now display limited quantities and purchase limits. Some dealers have quietly suspended orders entirely on certain high-demand items like Silver Eagles and popular private mint rounds. These are the early warning signs that precede full rationing, and they're appearing before the Perth Mint news is fully circulated through U.S. retail channels. By Tuesday or Wednesday, when American buyers wake up to what's happening internationally, those strain signals could become outright halts, mirroring what Perth just announced. Imagine trying to convert your paper silver to physical on Wednesday afternoon, only to find every major dealer either out of stock or requiring 4-week waits at premiums 20% higher than current levels. That's not a far-fetched scenario. That's what the supply chain data actually suggests could unfold this week. Consider what you'd regret more: securing physical metal now and watching the premium you paid become justified by market conditions, or waiting for confirmation, finding your preferred dealer out of stock, and watching prices run while you scramble for alternatives. The asymmetry of those outcomes should guide your decision-making over the next 72 hours. One path costs you a modest premium today that market conditions may soon validate. The other path risks watching the opportunity disappear entirely while you wait for perfect information that never arrives. I want to be clear about what this analysis is and isn't. This isn't a prediction that silver will definitely hit $91 by Thursday. Markets are complex systems with countless variables, and anyone claiming certainty about short-term price movements isn't being honest with you. Unexpected interventions could calm delivery stress. Major sellers could emerge to meet demand. Central bank statements could shift attention elsewhere. Markets constantly surprise even experienced observers, and humility about that uncertainty separates realistic analysis from hype. What this analysis shows is the mathematical scenario that emerges when you follow delivery data, inventory levels, and physical premium signals to their logical conclusion. The setup exists for that move. The conditions are present. The catalysts are converging. Whether the move materializes depends on how millions of market participants respond to the cascade of pressures converging this week. But the question serious investors should ask isn't whether this scenario is guaranteed. It's whether the probability justifies positioning for it. What I can say with confidence is that the evidence we've examined doesn't support business as usual in silver markets. Perth Mint didn't halt orders for no reason after 125 years of continuous operation. Comex deliveries didn't spike 4.5 times normal because traders are indifferent about receiving physical metal. Samsung didn't prepay $7 million for mine production months in advance because supply is abundant and easy to source. And our own government didn't designate silver as a critical mineral and begin strategic stockpiling because everything is fine with supply chains. These actions, from sovereign mints to major corporations to national governments, tell a consistent story. Physical silver is becoming genuinely scarce relative to demand, and the paper market pricing mechanism is lagging that reality by a significant margin. At some point, probably sooner rather than later, price will adjust to reflect physical conditions. The only question is whether you're positioned to benefit from that adjustment or scrambling to catch up after it happens. The Perth Mint halt wasn't a random operational hiccup. It was a signal flare that illuminates everything happening beneath the surface of silver markets. Record Comex withdrawals draining registered inventory month after month. Accelerating industrial demand from technologies that can't function without silver. Government stockpiling for strategic reserves that compete with private buyers. Export restrictions from major producers like China that remove supply from global markets. Annual deficits of 200 million ounces draining available inventory year after year with no end in sight. All of these forces have been building pressure quietly out of mainstream financial headlines, noticed only by those who track physical metal markets closely. Australia just showed us what happens when that pressure reaches critical mass. A system that looked stable suddenly reveals its breaking point. And once one major node fails, the stress transfers to remaining nodes that were already operating near capacity. Thursday's deadline approaches whether we're prepared or not. First notice day will reveal the true state of Comex delivery capacity, and that revelation will move prices accordingly. For silver owners who understand what's unfolding, this week represents an opportunity to position ahead of the crowd before the math becomes obvious to everyone. For those who dismiss these signals as noise or wait for mainstream confirmation, the next few days may deliver an expensive lesson in the difference between paper claims and physical reality. The mathematics point to $91 by Thursday. The fundamentals support 100 plus by the end of March. Premium expansion could add another 25 to 30% for physical holders. And the clock is ticking toward a deadline that could change how the world prices silver for months to come. The information is in front of you. The evidence is clear. What you do with that information before Thursday is entirely your choice, but that choice has consequences that will become very real very soon.